IVM.
Today, we're uncovering the roots of risk management. We're traveling back to a time when there were no apps, no stock markets, and no corporate boardrooms. Just traders, empires, and endless uncertainty. Sandstorms, pirates, wild animals, and fortunes made of gold and spices. Stick around to discover how the ancients mastered risk management and why their strategies are still relevant for your investments today. Welcome to today's episode. I'm Paritosh Anand and this is Season 2 of Finance Flashback brought to you by ICICI Prudential Mutual Fund. We're talking about something that can be super boring at first, but trust me, it's anything but. Risk management. It's a concept as old as human history. And believe it or not, those ancient traders, empires, and risk takers have a lot to teach us today. Lesson number 1. Diversification. The ancient Mesopotamian way. Picture this. It's 2400 BC in Mesopotamia. Traders are crossing vast deserts, dealing with sandstorms, robbers, and wild animals. Risky, right? But they didn't leave it to chance. These merchants came up with one of the earliest forms of insurance, pooling their goods. If someone lost their cargo, others pitched in to cover the loss. The takeaway? Diversification. Just like those traders spread their goods across the caravan, you should spread your investments as well. Don't put all your money into one asset class. Have a mix of equity, debt, and even real estate. And here's where hybrid mutual funds can be your modern-day Mesopotamian caravan. Hybrid funds invest in a mix of equity, debt, and other securities, helping you diversify your portfolio all in one go. They're designed to balance risk and reward, just like pooling resources protected the traders from unexpected losses. Because in investing, just like in ancient trade, one sandstorm shouldn't ruin your entire portfolio. Lesson number 2. Flexibility. The Roman Empire's secret. Fast forward to ancient Rome, one of history's most enduring empires. The Romans didn't survive for over 1,000 years just by sheer luck. They balanced ambition with strategy. Their wealth wasn't just in conquests. It was in trade, infrastructure, and innovation. But they also fortified borders and built reserves for stability. In investing, this translates into a balanced approach. Staying flexible with your portfolio ensures that you can adapt to changing markets, just like the Romans adapted to changing times. Lesson number 3. Setting limits. The Dutch merchant strategy. Let's jump to the 1700s Amsterdam, the world's trading hub. Dutch merchants faced storms, pirates, and unpredictable seas. But they didn't let uncertainty hold them back. They created contracts to cap their losses, essentially the first formal risk management practices. Here's the lesson. Before you invest, decide how much risk you're willing to take. Set limits and stick to them, whether it's a stop loss on your equity investments or a clear financial goal for your SIPs. Setting boundaries protects you from emotional decision making and sleepless nights. Lesson number 4. Staying informed. The Rothschild method. Now, let's talk about the legendary Rothschild family in the 1800s. Their secret? Information. They studied every political and economic change before making investment moves. Even during wars and financial crises, they stayed ahead by adjusting strategies instead of panicking. For you, this means staying informed. Keep an eye on market trends, global events, and economic policies. And if you're short on time, that's where mutual fund managers come in. They analyze markets to make informed decisions for you. So what's the biggest takeaway from today's journey through history? Risk management is timeless. Whether it's pooling goods in Mesopotamia, fortifying borders in Rome, setting limits in Amsterdam, or staying informed like the Rothschilds, the fundamentals remain the same. And here's the best part. You don't need to cross deserts, navigate pirate-infested waters, or decode political upheavals to manage your risks today. By diversifying your investments across various assets and investment options like debt, equity, commodity, amongst other options. While staying flexible, setting clear boundaries, and staying informed, you can manage risk and build a portfolio that weathers life's uncertainties, just like the ancients did. Thank you for joining me on this historical journey. Remember, take risks, but take them wisely. We'll see you in the next episode where we uncover more lessons from history to guide your financial future. Until then, happy investing. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.